Dear students, welcome to my channel. In the previous video, we have discussed the preparation of final accounts, that is trading account, profit and loss account and balance sheet. Along with we have discussed the preparation of manufacturing account, that is manufacturing, trading, profit and loss account and the balance sheet. Today let us discuss adjustments. Before that, there are two systems of accounting, cash system of accounting and accrual system of accounting. In the cash system of accounting, the actual cash received and paid, the actual receipt and payment will be considered for the accounting purpose. But in accrual system of accounting, the amounts due also would be considered or taken into consideration. After this financial year, that is after the preparation of the trial balance, there may be some payment or maybe some receipts which pertains to this particular accounting period. If bringing all these items into the books of account pertains to that particular accounting period is said to be accrual system of accounting. So under this system, whatever item that is accrued pertains to that particular accounting period or whatever item relating to that particular accounting period would be taken into consideration. Adjustments are nothing but bringing item which is standing outside the trial balance into the final accounts. So let us discuss each one of that item, how it would be dealt, what would be the adjusting entry to be passed, and how it is accounted in the books of account, trading account, profit and loss account and in the balance sheet. Every adjustments needs to be placed in two places. It could be either in trading account or in the profit and loss account depending on the type of item, but it must be in the balance sheet. That would be either in the asset side or in the liability side. So let us discuss each one of the item that would appear outside the trial balance, that is after the preparation of the trial balance, how we can deal it in the trading or in the profit and loss account, but definitely in the balance sheet. The first adjustment is closing stock. What is closing stock? Goods which are unsold at the end of the accounting period is said to be closing stock. The goods which remains at the end of the accounting period unsold is said to be closing stock. So what will be the closing or the adjusting entry? The adjusting entry is closing stock account debtor to trading account. This is the adjusting entry has to be passed to bring the closing stock into the books of account. Closing stock is given outside the trial balance. Journal entry, closing stock account debtor to trading account. So the twofold effect is in the trading account, credit side by closing stock. The same time in the balance sheet, asset side, closing stock. This is the twofold effect of the item closing stock. Suppose the closing stock given inside the trial balance, then it need not be taken in the trading account, but it needs only to be taken in the balance sheet just like any other asset. The second adjustment is outstanding expenses. The expenses which are incurred but the payment has not been made, such is said to be outstanding expenses, yet to pay not yet paid, so that it has to be bring into the books of account. So the journal entry is respective expenses account debtor to outstanding expenses. Say for example, if it is wages account debtor to outstanding wages account. So this will be the adjusting entry. Outstanding expenses has to be added along with the respective expenses and it to be written in the liability side of the balance sheet. So in the trading account, along with the wages, we have to add outstanding wages. This is the adjustment in the trading account. And in the balance sheet, liability side, outstanding wages. The third one is prepaid expenses. The expenses not yet due, but the payment is already been made. It is just opposite to the outstanding expenses. Here the payment is already done, but the expense has not incurred yet. For example, insurance prepaid. So what will be the adjusting entry? Prepaid expenses account debtor to respective expenses. Here the expenses has to be reduced. For example, insurance prepaid. So insurance account has to be reduced. To reduce an expense, it to be credited, and the prepaid insurance account has to be debited to the extent of the prepaid portion. And the twofold effect is in the P&L account from the insurance, the prepaid portion has to be deducted. It should deduct from the respective expenses in the P&L account. Prepaid expenses has to be deducted from the respective expenses in the debit side of the profit and loss account, and it should be written in the asset side of the balance sheet. Next one is accrued income. Accrued income means income is due but not received. So it to be taken into books of account, it to be added along with the respective income. So the adjusting entry is income accrued account debtor to respective income account. Say for example, interest due. So interest account to be credited since it is an income, and interest accrued account has to be debited. So the journal entry is income accrued account debtor to respective income account. And the twofold effect is it should be added along with the respective income in the P&L account. For example, interest. Add accrued income, accrued interest in the credit side of the P&L account, and in the balance sheet it should be written in the asset side, accrued interest. Next is income received in advance. Respective income account debtor to income received in advance. For example, rent received in advance. So rent account debtor to rent received in advance account. So that to the extent of that the amount received in advance will be reduced, and it is a liability, so that we have to write in the liability side of the balance sheet. So the twofold effect is, in the P&L account it should be deducted from the respective income and it should be written in the balance sheet liability side. Rent received less received in advance, it to be deducted, the balance to be written in the outer column. And in the balance sheet, rent received in advance in the liability side. Next adjustment is depreciation. Depreciation means diminution in the value of asset or reduction in the value of asset. How the reduction in the value of asset would take place? It may be because of usage. It may be because of the old age. It may be because of out of fashion. It may be evaporation. Maybe consumption. Maybe because of extraction. So all these would lead for depreciation or the reduction in the value of asset. So to reduce the value of asset, the asset must be credited. Respective asset account, and we have to debit depreciation. And depreciation is a loss to the business. So the depreciation account has to be debited and the respective asset account has to be credited. For example, machinery. Depreciation on machinery. So depreciation account debtor to machinery account. So while doing this exercise, to the extent of the amount of depreciation, the machinery account would be reduced. The twofold effect will be, in the P&L account, debit side to depreciation. We have to compute the rate of depreciation and the amount of depreciation. There are mainly two types of depreciation calculation. There is written down value method and straight line method. So as per the instruction given in the question, we have to work out, calculate the depreciation either in the mode of written down value or in the mode of straight line method. So after calculating that, the depreciation value has to be written in the debit side of the profit and loss account as a loss, and in the asset side of the balance sheet, we have to deduct that depreciation portion from the respective asset. For example, the machinery is having depreciation, so to the extent of the depreciation value we have to deduct, then the balance has to be written in the outer column. The next adjustment is interest on capital. Interest on capital is nothing but if any fixed amount paid to the businessman for the amount contributed to the business is said to be interest on capital. So basically it is an expense to the business and an income to the businessman. So the adjusting entry is interest on capital account debtor to capital account. So because of this interest on capital, the capital amount would increase, and the adjustment in the P&L account and balance sheet is, in the P&L account you have to write the debit side interest on capital, and in the balance sheet the interest on capital has to be added with capital. Interest on capital has to be added with the capital value. Here we are ignoring the income tax procedure. Next is interest on drawings. Drawings means the amount withdrawn by the businessman. Just like the interest given to the capital, the business is charging an interest from the businessman for his drawings. So it is basically an income to the business. So the entry is drawings account debtor to interest on drawings account. So the twofold effect is, in the profit and loss account, this interest on drawings will be written in the credit side of the profit and loss account. Interest on drawings, it is an income to the business. And in the balance sheet, it should be deducted from the capital. So the adjustment with respect to interest on capital in the balance sheet is, first we have to take capital, add interest on capital, then less drawings, then less interest on drawings. Along with, if net profit is there, that to be added. If it is net loss, that to be deducted from the capital. This is the case for sole trader, a single ownership business. So the businessman just wanted to know the profitability of the business and its financial position. And there is no difference between the business and the businessman. So whatever income generated by the businessman, it is from the business only. So that this account is prepared in such a manner. So capital, add interest on capital, less drawings, less interest on drawings, along the net profit or net loss would be adjusted. Hope this is clear. Please practice problems covering all these adjustments, that is outstanding expenses, accrued income, income received in advance, prepaid expenses, closing stock, depreciation, interest on capital and interest on drawings. Every adjustment has to be placed either in the trading account or in the profit and loss account, and it must be placed surely in the balance sheet. It may be in the asset side or maybe in the liability side, depending on the type of item. The remaining adjustments are bad debt, provision for bad debt, provision for discount on debtors, provision for creditors. All that we will be discussing in the next video. Hope this is clear. After completing all these adjustments, let us work out problem. So thank you very much for watching. If it is useful, please share it to your friends. Thank you.